Hello and welcome. In this chapter, we will discuss practical templates, checklists, and working papers for IFRS 9 or BFRS 9 implementation. In earlier chapters, we discussed the concepts of IFRS 9, classification and measurement, expected credit loss, PD, LGD, EAB, data requirements, governance, disclosure, implementation roadmap, and common implementation challenges. Now we will focus on documentation. IFRS 9 implementation is not complete only by calculating ECL. The bank must also maintain proper evidence to support the calculation, assumptions, judgments, approvals, and disclosures. A bank must be able to explain how financial assets were classified, how stages were assigned, how significant increase in credit risk was identified, how default was defined, how PD, LGD, and EAD were calculated, how forward-looking information was used, how management overlays were determined, and how ECL was reconciled with the general ledger. Without proper templates and working papers, the bank may face difficulty during internal audit, external audit, Bangladesh bank inspection, audit committee review, and board reporting. Therefore, templates are not only administrative documents. They are part of the bank's control framework. In this chapter, we will go through practical templates that may be used by finance, risk, credit, IT, internal audit, external audit, and senior management. The templates are illustrative. Each bank should customize them based on its own size, portfolio, policy, system, and regulatory requirements. Let us start with the first template, the IFRS 9 Implementation Status Tracker. This tracker is used by the IFRS 9 Implementation Committee to monitor the progress of different workstreams. IFRS 9 implementation involves many activities, such as governance, policy drafting, data preparation, model development, system configuration, disclosure preparation, and internal audit review. If these activities are not properly tracked, the project may be delayed. The tracker should include the workstream, key activity, responsible department, target date, current status, key issue, and next action. For example, the governance workstream may include formation of the implementation committee. The responsible department may be senior management. If the activity is completed, the next action may be to continue monthly meetings. For the data workstream, the key activity may be preparation of data inventory. The responsible departments may be IT and risk. If recovery data is missing, the next action may be to collect information from the recovery unit. This tracker should be updated regularly and discussed in IFRS 9 Implementation Committee meetings. Now let us discuss the second template, the IFRS 9 Policy Approval Checklist. Before final implementation, the bank should have an approved IFRS 9 policy. This checklist helps ensure that all important policy areas are covered. The policy should include classification and measurement, business model assessment, SP, P, attest, ECL methodology, default definition, SICR criteria, staging criteria, PD methodology, LGD methodology, IAD methodology, forward-looking information, scenario weighting, management overlay, policy, disclosure policy, and governance process. The checklist should show whether each policy area is included, who reviewed it, and who approved it. For example, classification and measurement may be reviewed by finance and approved by the audit committee. PD, LGD, and EAD methodology may be reviewed by Risk and approved by the Risk Management Committee. Management overlay may be reviewed by senior management and approved by the Audit Committee or relevant committee. The key message is, a tracker helps monitor implementation progress, and a policy checklist helps confirm that the bank has an approved and complete IFRS 9 policy. The next templates relate to classification and measurement. Under IFRS 9, classification of financial assets depends mainly on two things. First, the bank's business model for managing the asset. Second, whether the contractual cash flows pass the SPPI test. SPPI means solely payments of principal and interest. The business model assessment working paper helps the bank document why a financial asset is measured at amortized cost, FVOCA or FVTPL. For example, term loans to customers are usually held to collect contractual cash flows. The bank earns interest income and monitors credit performance. Therefore, the business model may be held to collect. Government treasury bonds may be held both to collect interest and to sell for liquidity management. Therefore, the business model may be held to collect and sell. Trading securities are held for short-term gains and are evaluated based on fair value movement. Therefore, they are usually measured at fair value through profit or loss. Balances with banks may be held to collect contractual cash flows. Derivatives are generally measured at fair value through profit or loss. Now let us discuss the SPPI text checklist. The SPPI test checks whether the contractual cash flows are only payments of principal and interest. The checklist should ask questions such as, is the instrument a basic lending arrangement? Are the cash flows fixed or variable, based on a normal market interest rate? Do the payments represent principal and interest only? Is interest compensation for time value of money and credit risk? Is there any profit-sharing feature? Is the return linked to the borrower's revenue or profit? Is there any equity conversion option? Is there any leverage feature? If the answer shows that the instrument contains only principal and normal interest, it may pass the SPPI test. If the instrument has equity-like return, profit-sharing return, or leveraged feature, it may fail SPPI and be measured at fair value through profit or loss. The key message is, business model and SPPI documentation are essential to support classification and measurement under IFRS 9. Now let us move to templates for impairment and staging. The stage classification working paper is one of the most important documents under IFRS 9. This template helps support whether a loan is classified as Stage 1, Stage 2, or Stage 3. The template may include borrower name, facility type, outstanding amount, days past due, rating change, rescheduling status, watchlist status, default indicator, stage and reason for stage classification. Let us take a few examples. ABC Manufacturing Limited has a term loan of BDT 100 million. It has 0 days past due, no rating downgrade, no rescheduling, no watchlist, and no default indicator. This loan may be Stage 1 because it is performing. XYZ Trading has a working capital loan of BDT 50 million. It is 45 days past due and also on the watch list. This loan may be Stage 2 because credit risk has increased significantly. PQR Textiles Limited has a term loan of BDT 200 million. It is 120 days past due, rescheduled, and has a default indicator. This loan should be Stage 3. This working paper helps auditors and management understand why each stage was assigned. The next template is the SICR assessment checklist. SICR means significant increase in credit risk. This checklist helps determine whether a loan should move from Stage 1 to Stage 2. Indicators may include more than 30 days past due, significant rating downgrade, watchlist status, restructuring due to financial difficulty, decline in sales or cash flow, breach of covenant, adverse sector outlook and management concern. For example, if a borrower is 45 days past due, its rating moved from Grade 3 to Grade 6, it is on the watch list, and its latest financial statement shows declining cash flow, the borrower should normally be considered Stage 2. The next template is the definition of default checklist. This checklist helps identify Stage 3 or credit-impaired assets. Default indicators may include more than 90 days past due, unlikely to pay in full, legal recovery action, bankruptcy or liquidation, non-performing classification, restructuring due to severe financial difficulty, and write-off. For example, if a borrower is 120 days past due and classified as non-performing, it meets the default definition and should be Stage 3. The key message is Stage Classification, SICR assessment, and default assessment should be documented with evidence, not decided informally. Now let us move to templates for impairment and staging. The Stage Classification Working Paper is one of the most important documents under IFRS 9. This template helps support whether a loan is classified as Stage 1, Stage 2, or Stage 3. The template may include borrower name, facility type, outstanding amount, days past due, rating change, rescheduling status, watchlist status, default indicator, stage and reason for stage classification. Let us take a few examples. ABC Manufacturing Limited has a term loan of BDT 100 million. It has 0 days past due, no rating downgrade, no rescheduling, no watchlist, and no default indicator. This loan may be Stage 1 because it is performing. XYZ Trading has a working capital loan of BDT 50 million. It is 45 days past due and also on the watch list. This loan may be Stage 2 because credit risk has increased significantly. PQR Textiles Limited has a term loan of BDT 200 million. It is 120 days past due, rescheduled, and has a default indicator. This loan should be Stage 3. This working paper helps auditors and management understand why each stage was assigned. The next template is the SICR assessment checklist. SICR means significant increase in credit risk. This checklist helps determine whether a loan should move from Stage 1 to Stage 2. Indicators may include more than 30 days past due, significant rating downgrade, watchlist status, restructuring due to financial difficulty, decline in sales or cash flow, breach of covenant, adverse sector outlook and management concern. For example, if a borrower is 45 days past due, its rating moved from Grade 3 to Grade 6, it is on the watch list, and its latest financial statement shows declining cash flow, the borrower should normally be considered Stage 2. The next template is the definition of default checklist. This checklist helps identify Stage 3 or credit-impaired assets. Default indicators may include more than 90 days past due, unlikely to pay in full, legal recovery action, bankruptcy or liquidation, non-performing classification, restructuring due to severe financial difficulty, and write-off. For example, if a borrower is 120 days past due and classified as non-performing, it meets the default definition and should be Stage 3. The key message is Stage Classification, SICR assessment, and default assessment should be documented with evidence, not decided informally. Now let us discuss templates for PD, LGD, and EAD. These are the three main components of ECL calculation. PD means probability of default. LGD means loss, given default. EAD means exposure at default. The PD calculation, working paper, may use a simple historical default rate approach. For example, assume the bank has SME borrower data. In 2023, there were 50 borrowers, and 180 defaulted. The annual default rate is 3.60%. In 2024, there were 500 borrowers and 220 defaulted. The default rate is 4.00%. In 2025, there were 60 borrowers and 270 defaulted. The default rate is 4.50%. The average historical default rate is 4.03%. Now the bank considers forward-looking information. If inflation is rising, the bank may add 0.50%. If interest rate is increasing, the bank may add 0.30%. Total adjustment is 0.80%. Therefore, final PD becomes 4.03% plus 0.80%, which equals 4.83%. This working paper shows how historical data and forward-looking adjustment are combined. Now let us discuss the LGD calculation working paper. LGD is based on expected loss after recovery. Assume the bank reviews 5 defaulted loans. Total exposure at default is BDT 410 million. Total net recovery is BDT 223 million. Therefore, total loss is BDT 187 million. LGD is total loss divided by total exposure. So, LGD is 187 divided by 410, which equals 45.61%. The bank may use approximately 46% LGD for similar loans, subject to adjustment for current collateral and recovery conditions. Now let us discuss the EAD calculation working paper. For a term loan, EAD may be the outstanding balance. But for a revolving facility, the borrower may draw unused limits before default. Assume approved limit is BDT 100 million. Current outstanding is BDT 60 million. Undrawn limit is BDT 40 million. Expected utilization before default is 50%. Expected additional drawing is BDT 20 million. Therefore, EE is BDT 60 million plus BDT 20 million equal to BDT 80 million. The key message is PD, LGD, and EIE should not be unsupported numbers. Each should have a working paper showing data, assumptions, calculation, and approval. After calculating P, L, G, D, and E, A, D, and EAD, the bank should prepare an ECL calculation summary. This template summarizes ECL by borrower or portfolio. For example, ABC Manufacturing Limited is Stage 1 with EAD of BDT 100 million, PD of 2%, and LGD of 35%. EICL is BDT 0.70 million. XE Trading is Stage 2 with EAE of BD 50 million, PD of 15%, and LGD of 45%. ECL is BDT 3.38 million. QR Textiles Limited is Stage 3 with EAD of BDT 200 million, PIE of 100%, and LGD of 60%. ECL is BDT 120 million. This summary helps management identify which borrowers or portfolios contribute most to total impairment. Now let us discuss the Management Overlay Memo. A management overlay is an adjustment to model output where management believes the model does not fully capture certain risks. For example, the model ECL for import-based SME borrowers is BDT 10 million. Management applies a 10% overlay due to exchange rate volatility and import settlement pressure. The overlay amount is BDT 100 million. Adjusted ECL becomes BDT 100 million. The overlay memo should explain the affected portfolio, reason for overlay, calculation basis, supporting evidence, approval authority, and review date. The explanation should not simply say management believes more provision is required. It should clearly explain the economic and credit risk basis. Now let us discuss the scenario weighting working paper. IFRS 9 requires probability-weighted outcomes. For example, optimistic scenario, ECL is BDT 800 million, with 20% weight. Weighted ECL is BDT 160 million. PACE scenario, ECL is BDT 70 million, with 60% weight. Weighted ECL is BDT 200 million. Pessimistic scenario, ECL is BDT 755 million, with 20% weight. Weighted ECL is BDT 951 million. Total probability-weighted ECL is BDT. The key message is ECL, summary, overlay, and scenario weighting should be clearly documented and proved. Now let us discuss macroeconomic assumptions and reconciliation templates. The macroeconomic assumption memo documents the economic variables used in ECL calculation. These variables may include GDP growth, inflation, lending rate, exchange rate, export growth, and real estate price growth. For example, under the base scenario, GDP growth may be 5.8%, inflation 8%, lending rate 10.5%, and exchange rate BDT 118 per US dollar. Under the pessimistic scenario, GDP growth may be 4.5%, inflation 10%, lending rate 12%, and exchange rate BDT 125 per US dollar. The assumptions should be reasonable, supportable, and approved. The bank should also document the source of assumptions and explain changes from the previous reporting period. Now let us discuss ECL to general ledger reconciliation. Assume ECL model output is BDT 311 million. The ECL balance in the general ledger before adjustment is BDT 950 million. The difference is BDT 361 million. Therefore, additional impairment journal required is BDT 361 million. The journal entry is debit impairment loss expense BDT 361 million. Credit ECL allowance BDT 361 million. This reconciliation is important because the ECL model result must agree with accounting records. Now let us discuss accounting ECL versus regulatory provision reconciliation. In Bangladesh, accounting ECL under IFRS 9 may differ from Bangladesh bank regulatory provision. For example, IFRS 9 ECL is BDT 711 million, while regulatory provision required is BDT 78H55555. The bank should explain why the difference exists and how it will be treated according to applicable regulatory requirements. The key message is assumptions and reconciliations are critical for audit readiness and regulatory reporting. Now let us discuss disclosure and audit readiness. IFRS 9 requires detailed disclosures in the financial statements. The disclosure preparation checklist helps ensure that all required areas are covered. The checklist may include accounting policy, classification and measurement, ECL methodology, stage-wise exposure, ECL allowance by stage, movement in ECL allowance, SICR criteria, definition of default, forward-looking assumptions, scenario analysis, management overlay, collateral disclosure, write-off and recovery, sensitivity analysis, and regulatory reconciliation. Each item should have a working paper reference and review status. For example, accounting policy may refer to working paper WP 1. Stage-wise exposure may refer to W4. Scenario analysis may refer to WP 10. Management overlay may refer to WP 11. This helps finance and audit teams trace each disclosure number to supporting documents. Now let us discuss the audit readiness checklist. Audit readiness means the bank is prepared to support its ECL calculation and disclosure before internal audit, external audit, and regulatory review. The checklist may include approved IFRS 9 policy, ECL methodology, data source mapping, data quality review, stage classification support, SICR assessment, default definition, PD model, LGD model, EAD model, scenario weighting, management overlay, GL reconciliation, regulatory reconciliation, disclosure workings, and management approval. If any key evidence is missing, the bank should resolve it before finalizing the financial statements. For example, if management overlay is included but no overlay memo is available, this is an audit risk. If scenario weights are used but not approved, this is also an audit risk. The key message is disclosure and audit readiness checklists help ensure that the ECL number is not only calculated but also properly supported. Now let us discuss management level templates. The first is the Management Reporting Dashboard. This dashboard helps senior management and the board understand key IFRS 9 results. It may include total gross exposure, total ECL allowance, coverage ratio, Stage 1 exposure, Stage 2 exposure, Stage 3 exposure, Stage 2 migration, management overlay, and regulatory provision difference. For example, total gross exposure may be BDT 100, 0 million. Total ECL allowance may be BDT 7300, 11 million. Coverage ratio may be 7.31%. If Stage 2 exposure increased from BDT 9, 0 million to BDT 11, 840 million, management should investigate whether credit risk is increasing in specific sectors or products. The next template is the Issue Log and Resolution Tracker. This log helps track unresolved matters. For example, missing default dates for SME loans may be assigned to risk and credit departments. Outdated collateral valuation may be assigned to credit administration. Pending formula review may be assigned to finance and risk. Scenario weights pending approval may be assigned to the risk committee. Each issue should have risk level, target date, current status, and resolution. The next template is training attendance and competency record. Training records, Demonstrate that relevant staff have been trained. For example, board and senior management may attend IFRS 9 overview training. Finance and risk teams may attend ECL model training. Credit and branch teams may attend staging and SICR training. OT may attend data requirements training. Internal audit may attend audit readiness training. The final template is final implementation sign-off. This sign-off confirms that all important areas are ready for implementation. It may include sign-off for IFRS 9 policy, data validation, PD model, LGD model, EAD model, staging model, system testing, parallel run, disclosure, internal audit review, and board approval. The key messages: management dashboard, issue log, training records, and sign-off documents help ensure governance, accountability, and successful implementation. Let us now summarize the practical use of these templates. The templates in this chapter may be used for IFRS 9 implementation project tracking, ECL, calculation support, stage classification documentation, SICR assessment, PD, LGD, and EAD working papers, management overlay approval, scenario weighting support, disclosure preparation, audit readiness, internal audit review, board reporting, staff training, and regulatory inspection support. Each bank should customize these templates according to its own portfolio, system, governance structure, and regulatory requirements. The main purpose of these templates is to create consistency, transparency, audit trail, and management accountability. A good IFRS 9 working paper file should include approved IFRS 9 policy, business model assessment, SPP test, stage classification, SICR assessment, default assessment, PD calculation, LGD calculation, CAD calculation, scenario weighting, management overlay, ECL summary, reconciliation, disclosure, support, and audit readiness checklist. For banks and financial institutions in Bangladesh, proper documentation is especially important because implementation may involve data limitations, rescheduled loans, collateral valuation issues, regulatory differences, and significant management judgment. Well-designed templates make IFRS 9 implementation more practical, reviewable, auditable, and sustainable. In short, IFRS 9 is not only about calculating ECL. It is also about proving how the ECL was calculated, reviewed, approved, and reported. Thank you for watching.